Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. Thank you so much for joining us today for a webinar on strategic income tax planning. For those of you joining us for the first time today, my name is Amanda Murray. I am the Client Service Associate for Stonehearth Capital Management. I've been with the firm for about 3 years, and my responsibilities primarily focus on client service, marketing, and compliance. So I'm very excited, along with my colleagues, to be able to offer you these free monthly webinars. I want to just review a few line items before we begin. Throughout the webinar, please feel free to submit any questions using the questions section of your taskbar. I will be personally monitoring these questions, and we will review as many as we can during the questions portion of the webinar. This webinar is recorded for compliance purposes, and it will be available to view on our website by the end of the business day tomorrow. A corresponding white paper is currently available on our website at www.stonehearthcapital.com. To find it, you can choose Resources from the orange taskbar on our homepage and click White Papers from the drop-down menu. Also on our website is the webinar calendar for 2018, so please make sure you head over to check out and register for some of our new topics for next year. As always, these webinars are complimentary and all are welcome to join us. I am honored to introduce our speaker for today. Jamie Upson is Stonehearth Capital Management's president and CEO. He started with the firm in 2000 and spent the first couple of years focusing on portfolio management design, strategy, and product analysis. In 2006, Jamie passed the Certified Financial Planner exam, which is designed to teach designees how to help families meet their financial goals and plan for their future. And for the next 11 years, Jamie co-managed client portfolios while building, analyzing, and monitoring client financial plans. And just this year, Jamie purchased the firm from Stonehearth's original founder, Richard Prout. As his colleague, I know how excited he is to lead SCM forward and continue to help clients meet their financial goals. Today, he will be discussing strategic income tax planning and how the new tax reform impacts your finances. Thank you so much, Jamie, for joining us today.
Great. Thank you, Amanda. Welcome, everyone. Happy holidays. I guess we got Happy New Year's is on the horizon here. When we put this schedule together about 12 months ago, I wasn't sure how many people we'd have joining us for strategic tax planning. We tend to get a smaller number of people that want to actually discuss taxes. However, this is proving to be one of our more popular ones, and I have a feeling that is tied to the tax reform. Now, one of the challenges that we have here in our industry is that we need to put together these presentations not on the fly, but in advance so that compliance teams can review our slides. So this presentation that you're going to see was put together about a month ago. We obviously knew that the tax reform proposal was at that time a proposal. And since then, we actually have it now as part of law. So what I'm going to do is I'm going to show you the slides, and then after I'm done going through the slides, I'm actually going to transition into the tax reform and try to identify those popular areas that a lot of individuals want to hear about. I'm not going to spend a lot of time talking about the corporate side. I have a couple of prepared remarks about the corporate side, but nothing much. It's really to focus on the individual side so you can hear the changes that are coming our way, and some of which have already been implemented, believe it or not. There's only a couple, but most of these are going to be implemented starting January 1st, and they're actually going to expire at the end of 2025. So many of these things are temporary. Some of them are scheduled to be, not really scheduled, but they're part of the law that's not supposed to sunset or expire. And when applicable, I'll try to highlight some of those areas. So a few comments about the tax reform. This was a pretty sweeping change in terms of tax changes or adjustments. Probably the biggest one that we've seen was since 1986, well, before I was even in the industry. But I've read a lot about the 1986 changes, and this one is something that people put on par with the magnitude of what we saw back in 1986. Just a reminder, the tax reform was passed last week. So again, we're still digesting some of these. We're really trying to not only understand what the changes are, but also putting together strategies around them. Some of the, I mean, a lot of things did not change. So a lot of the strategies that I'm going to discuss in my prepared slides, I'll actually highlight that they're still available going into 2018 and going forward until Congress changes the laws and takes some of these opportunities away from us. So without further ado, I'm going to start going over my prepared remarks that I, again, prepared, really focusing on year-end tax strategies that I want people to identify, not just this year, but also in years going forward. I came across this in my research for this presentation. You must pay taxes, but there's no law that says you got to leave a tip. I thought that was pretty clever in a prior advertisement that Morgan Stanley put together. This is one of those areas that a lot of things are black and white. There are some areas of gray and open for discussion, but it's an area that I want to be careful about taxes. I certainly don't want to pay more than I owe, and I want to be very conscious of my options that I have available to me. So the things that we're going to address in the first part of this presentation, at a high level, we're going to find ways to reduce your income. The next thing we're going to try to do is increase your deductions, which also helps to reduce your income. We're going to increase your credits, which for those that aren't super savvy about the tax structure, credits are the best type of thing that you can have when it comes to filing your taxes. Deductions are second best, and obviously those two things help reduce the amount of taxes that you ultimately end up owing. The power that credits offer is that they're a dollar-for-dollar reduction of the calculated tax that you owe. So if you owe $10,000 and then you start to apply credits to that, if you have a $1,000 credit, then you now owe the government $9,000 because of that $1,000 credit offset. So credits are the best things out there. Unfortunately, there's not a ton of ways to increase the credits, but there are a couple of them. I'm going to also talk about increasing your income, and I have a big question mark there after what, because I just said at the beginning here, we're going to find ways to reduce your income. There are scenarios that I've come across in reviewing tax returns that we found that, you know what, people really shouldn't be looking at ways to reduce their income. They should actually be looking at ways to increase, and I'm going to go through an example with you. And then just for fun, across my studies and being in this business for the last 18 years, I've got a couple of tidbits that in particular in Massachusetts that people want to pay attention to. Some of these could apply to other states, but it is a state-by-state measuring stick that you have to go and look at what those rules are within your state. But it at least points out some of the strange things that exist, or things that a lot of people didn't expect, that if you're within your own state, you probably want to do a little bit of research and digging to find out what your state, how it applies. So the first area, we're going to talk about reducing your income. One of the things that we do for all of our clients that have taxable accounts, and what I mean by taxable accounts are personal accounts, joint accounts, trust accounts. What I'm not talking about are IRA accounts, Roth, annuities. So taxable accounts, what happens is when you place a trade, you have to report either a profit or a loss to the government. And whenever you place a trade, if you earn dividends or interest, you also have to report those dividends and interest on your tax return. So one of the things that we look for helpful ways to help reduce some of the tax ramifications from your portfolio is a strategy known as tax loss harvesting. What that means is if we have any positions within client accounts, any taxable accounts, we apply a rule of five, what we call 5 and 5, but it's $5,000 and 5% rule. What that means is if we see within a client account that they have a position that has not cooperated and has sold off and is greater than $5,000 and 5% of the account value, then we will just go ahead and sell that security. If we can't find another product to put the proceeds into, then we can sit in cash for 31 days. If we can find a product that we're comfortable parking the money in for 31 days, we'll do that. And then the beauty of it is we can then, after 31 days, we can go back into the original position that we sold at a loss. So the power of this is that those losses, if we realize $10,000 of losses, I can use those losses to offset $10,000 of gains. In fact, if I only have $7,000 of gains, I'm actually able to wipe out those $7,000 of gains with the losses that I realized in the portfolio. And in that scenario, I'd have $3,000 of net losses. And the beauty of it is you can use those net losses to offset other forms of income like wages. So again, these are all strategies and ways that you can help reduce your income, which should help reduce your tax liability. And one of the things that some people say is, can you have enough carry forward losses? Is there a concern that you have too many? Well, the reality is that you can carry these things forward indefinitely, except for when you pass. So you can't bring them with you. But while you're alive, while you or your spouse are living, you can carry these losses forward. And that's a helpful tool to have in your back pocket, especially when markets start to run like they have and you want to start trimming some winners. Well, inevitably that ends up resulting in capital gains, and it's nice if you have some capital losses in your back pocket that you can help to offset those profits with. The next section and way that people can reduce income is through donations or philanthropy. It's in particular, I'm going to talk about qualified charitable distributions. I believe I have another example on donating appreciated stock. But one of the important ways for those people that do have philanthropic desires, and if they happen to be over 7.5 and have retirement assets that they need to take required minimum distributions from, one of the cool parts is that you can actually have up to $100,000 of those distributions if paid directly to the charity, and it's got to be a qualifying charity. If paid directly to that charity, you actually don't even have to report the amount that you donated on your tax return as taxable income. You still have to put it, there's two boxes. There's one that shows gross distributions, but then another box is taxable distributions. Next to that box, you usually write QCD next to it to tell the IRS that the reason those numbers are different is because whatever the delta is what you donated to charity. So for example, if you have a required minimum distribution of $50,000 and you want to donate $20,000 directly to a charity, then you report $50,000 of gross distributions. That tells the IRS that you satisfied your required minimum distribution. Oh, and by the way, only 30,000 of it is taxable because we donated 20,000 to charity. There are multiple benefits to this that a lot of people actually aren't even aware of, and it's those decisions or abilities to take advantage of certain things later on in the tax return that utilize AGI to determine whether you're allowed to do them or not. And some of them I have listed here: itemized deductions and exemptions. By the way, exemptions are going away in 2018, but we still have itemized deductions. I'll talk more about that in a bit. Roth contribution eligibility. Now, if you're going to contribute, you still have to be working and you have to earn below a certain amount of money. So again, ways to reduce your income is if you actually made a donation with your required minimum distribution, then we can help qualify. Depending upon how much we do, we can help make it so that you can contribute to a Roth. The next one that's going to catch a lot of people more and more by surprise more and more each year, I think, is going to be the Medicare surtax and premium costs. In fact, in 2018, they shortened the brackets of income that will determine how much you need to pay in Medicare premiums. This, again, is surprising when people, I don't know when they get the letter, probably, I'm guessing, like November or December, when they get a letter from Medicare saying, oh, and by the way, next year your premiums are this, and we're adding a surtax to it because of your income 2 years ago. So that's an unwelcome surprise by a lot of people, and if they want to help reduce their AGI and income, that could actually help reduce their Medicare premiums. Taxability of Social Security benefits, and some credits are also phased out. So again, if your income exceeds a certain amount, then you start to get phased out and you don't get those credits. Whereas if you made a charitable donation directly from your IRA to the charity, that would help reduce your AGI and may allow you to utilize more of the credit. I like doing these polls. Those of you that have joined us for the last 12 months have seen a handful of these. So what I'm going to talk about is our solo 401ks, and this again are ways to help reduce income. My question here, let me see if I can get that to launch. I hope you can see this. It says, what is the maximum amount that can be added to a solo 401k in 2017? Now, it's like a 401k, but it's for a sole proprietor, self-employed business owner who has no employees except their spouse. So in many respects, it's very similar to traditional 401ks that a lot of big corporations have. So what is the maximum amount that you think that can be added in 2017? 18,000, 24,000, 36,000, 48,000, or 60,000? We've got about half of you that voted. Go ahead and I'll leave it open for a little bit longer. Nice, we got just about everybody that voted. I'm going to close the poll and I'll share the results. And you can see that most people thought it's 18,000, which is true for 401ks. That's the employee contribution, which I believe in 2018 is going up to 18,500. For those that are over the age of 50, they're allowed to put in $24,000 in 2017. So again, that is true for traditional 401ks, but we're talking solo 401ks. And believe it or not, the actual answer is $60,000. We've been using these plans now, if I had to guess, maybe 7 years for self-employed individuals. So if somebody makes, $100,000, I think the math works out to like $40,000 that person can put into a solo 401k. So much more than a lot of people that work at larger corporations that have a defined contribution 401k plan. So this makes solo 401ks pretty popular. I still don't think a lot of people, self-employed individuals, are aware of it. A lot of them will still use SEPs, which are okay, but they are not, you cannot put as much money in most scenarios as you can into a solo 401k. There is one catch with solo 401ks. You do have to set them up before year end. So if somebody wants to contribute, they don't have to, for 2017, you don't actually have to contribute right now, but you got to set up the plan before year end. So if there's somebody on the phone that's self-employed and wants to discuss this, just give me a call. We have a couple of days to set up a solo 401k plan. And then if you end up using it, then, or if it does prove that it's beneficial to you, then we can fund it before you file your taxes. All right. So let's go back here. So again, owner-only businesses, the employee can put up to 18,000 plus $6,000 catch-up, plus the employer, which sole proprietors or self-employed, they are both the employee and the employer. So what most people identified was the employee component that you can put into a retirement plan. And then obviously some people picked up on the catch-up contribution. But what's beneficial for self-employed is that they're also the employer and they can put up to another 25% of the income. So again, that maxes out at $60,000 for somebody that's over the age of 50. Another way to reduce your income, people are familiar with Social Security and the fact that back in, I think it was the 80s, early 80s, when Social Security was not taxable at all. I think Reagan changed that so that they started to tax it. And as of now, the rules state that depending upon your taxable income and half of your Social Security benefits, up to 85% of your Social Security benefits are taxable. For some people, it's zero, but up to 85% of your Social Security benefit gets reported onto your tax return and you have to pay taxes on it. That means that the remaining 15% is tax-free. And as you can see on this chart here, if you delay turning benefits on, you can start collecting benefits, retirement benefits at 62. It's age 60 if you're a widow or a widower, but at 62 for retirement benefits. and you can delay it all the way to age 70. And just in this example, I wanted to show you what changes with the monthly benefit. Equate that to an annual benefit, 85% of that, which is what goes on the tax return, $2,700, which represents the tax-free income. So as you can see, you increased your tax-free income by about $2,000, and this is per year when we're looking at it at this level. But hey, you know, it's another way that you can increase your guaranteed sources of income. And by the way, because benefits increase at 7 to 8%, in particular after you hit full retirement age, those benefits are growing rather nicely. So for those that are comfortable delaying benefits, then you can actually increase your tax-free income, which I think everybody likes. I did say that I was going to talk about donating stock, highly appreciated stock. So now we just completed talking about ways to reduce your income. Now we're gonna look at ways to increase your deductions. So again, if you're philanthropic of nature and you want to make a donation to a charity, one of those options to look at your portfolio and identify if you have any highly appreciated stock. A good example of that these days would be if you have any Apple stock, if you were fortunate to have a nice profit in this. If you paid $100,000 in this example and it's worth $500,000, to you it's really worth, the way that you can spend that money, it's really worth about $400,000 to you, because you and I have to pay taxes when we sell Apple stock, especially if it's in a taxable account. Just a reminder, federal taxes can peak as high as 23.8% when we reach the status of long-term capital gains, and it's dependent upon your income levels that will determine what your capital gain rate is. The good news, by the way, that the capital gain rates did not change with the tax reform. Again, I'll talk about that in a bit. But if you choose a charity and you donate the stock, you just give them the stock. You don't sell it first and then give them cash. You give them the stock, and the reason for that is because charities do not pay taxes. So they receive $500,000 of Apple stock. They go ahead and they sell it. Because they sold it and they don't pay taxes on it, they get to keep $500,000. And the beauty of this is you got a charitable deduction for $500,000 in this example, not $400,000. So again, if you have excess savings or investments, meaning you have more money than you really need to live the rest of your life and you want to make charitable donations, this is an effective tool to do that. We're going to switch to ways to increase your credits. I do like this. It's tax season, the time of year when we really appreciate our kids. So one option that we all have available is to increase the number of kids you have more kids. That will increase the number of credits. I think we're going to be giving them extra bear hugs next year, because starting in 2018, one of the trade-offs here where Congress took away some things, that to offset that, they increased the credits available per child from $1,000 to $2,000 per child. And they also added an extra credit for if you were taking care of, there was another dependent like a parent. If you had a parent that you were taking care of and they were living with you and they were your dependent, they're giving you a $500 credit. The other way that you can increase your credits that I see most oftentimes is energy credits for those people that are putting solar panels on their home, upgrading appliances, or getting purchasing electric cars. Now I'm going to focus on ways to increase your income, and I'm going to try to explain one of the reasons why, or the one that I look for most often, or the one that I find most often. Unfortunately, sometimes you don't find out these things until after the tax returns have been filed, and somebody calls me up and says, "Hey, Jamie, guess what? We didn't owe taxes this year. That was a surprise." And I said, "Oh, well, what's going on?" "Oh, well, we had these really large medical expenses." Oh, and those medical expenses just started burning through all of the income. Because remember, medical expenses are a deduction, and deductions help to reduce your income. So if you have $100,000 of medical expenses and you have $50,000 of income, again, just keeping things simple, you're going to use up, or you're going to use only half of your medical deductions to offset all of your income. That means that you still have extra deductions available, and it is a use it or lose it system. So if you still had more deductions available, then how do you use those things up? Because it's not like we can go to our boss and just say, hey, I need more income. That would be nice if we could. And just say, I need more income because I have these deductions that I want to use up. So what we start looking for are ways to increase people's income or families' income so that they can use up the available deductions. And the one that I see most of the time are medical expenses. Somebody goes into an assisted living or a nursing home, and as long as they're qualified medical expenses, then you get to write those off. And as we are, I'm sure, are all aware, these expenses can be rather large, and most of those expenses are not covered by insurance, so they are truly out of pocket, and they become medical expense deductions. So one way to increase your income, remember that when you used to put money into IRAs or 401ks, you didn't pay taxes on the money that went into those plans. Well, when you start taking the money out of those plans now, those become taxable income. So as long as people are over the age of 59 and a half and they have access to their retirement plan, and if they have a whole bunch of medical expenses, then one of the things that we do is we say, well, if you need your portfolio to supplement your income because you have these rather high expenses, well, let's start taking the money out of your IRA account and not touching the taxable accounts. And again, it feels a little strange because we've been programmed to not touch those retirement accounts. If somebody says, well, no, I'd still prefer to spend down the taxable account, one of the other options that we have is to convert part of the IRA over to a Roth. And actually, I talk about that down below here. So one of the things that you want to just pay attention to, it's for you, it's also if you're doing somebody else's tax returns. I do my parents' tax returns, so when I'm doing their taxes, I'm always looking to see, are we making sure that we're utilizing all of their deductions that are available to them? I guess the same concept applies with credits. Are we making sure that we're utilizing all of these advantages that they have available to them? If somebody's not paying taxes, I would argue that you're probably missing an opportunity. Not always, because sometimes people never pay taxes, and we don't need to artificially accelerate some income so that they start paying some taxes today. What I'm really looking for are people that clearly have a whole bunch of medical expenses, and we're looking to offset or utilize those deductions. The next section, again, one of the reasons that we increase income, I already alluded to it, is when we want to take money out of an IRA. One of the opportunities that we have available to us is when we take money of an IRA, as long as it goes straight to it, we could move the money over into a Roth. A Roth is the best type of account that anyone can inherit. It's a tax-free account. And it grows tax deferred, and when we finally take the money out, the benefits, the profits are also tax free. So it is one of the best accounts out there. But in order to get the money into this, somebody has to pay taxes while the money's being converted. I just want to show you this example of something that within our financial planning software that I look for. I'm not the only one. Dave also analyzes these and looks for these. Jenna, when she's putting these plans together, she highlights, we run this report on a regular basis. And graphically, what we see here is when somebody's working, this represents their tax liability on the left-hand side here, and this represents their age on the bottom axis. So as somebody continues to work, they're 50, 55, 60 years of age, and then they decide to retire. Well, their tax liability just drops off in most instances, especially if they are going to start receiving Social Security, because not all of it's taxable, especially if they save taxable accounts, that we can start utilizing the taxable accounts, which are not as tax inefficient as IRA accounts. So what we do is we tend to see that their tax liability goes way down until they hit 70 and a half again, when the IRS forces them to start taking required minimum distributions once again. So what we found is that if we can smooth the taxes out, and we probably could even build this plan so that it's even a little bit smoother, but the point is that if we proactively decide to pay taxes after retirement but prior to age 70 and a half, this seems to be the sweet spot for the scenario, then we can actually have a pretty sizable impact on how much people will pay in taxes throughout their lifetime. Now, just these are well, I guess they're not to scale, but notice that it sort of peaks out here right around 75 to 80, and notice this one peaks out right around 55 in that vicinity. So you can see, and this is thousands of dollars, $55,000 is what they project the tax liability is going to be where my mouse is, versus about $78,000 in each one of these years. So you can see that if we just proactively decide to convert some IRAs over into Roth accounts, we can actually have a really nice impact over somebody's lifetime and also improve the structure and the type of accounts that their heirs will receive, because Roths really are the best type of account that you can receive. The next section, I'm sorry, so poll number 2. Here's a question for you. In Massachusetts, and I'm sorry to those people that are joining the call that are not from Massachusetts, but in Massachusetts, anyone, can you tell me what the short-term capital gain tax rate is? And what short-term means is if you buy a stock and you sell it within 12 months, if you have a profit on that, what is the tax liability that's going to be associated with that? And sorry, I just went to the wrong slide. What tax rate? Good. Let me launch that. So again, what tax rate does Massachusetts charge if an asset is held for less than 1 year? Go ahead, I'll let people, we're seeing they're coming in fast and furious. We get about 40% of the votes in. So the audience here is pretty well informed. This one, so I'm going to close the poll and I'll share the results. 70% of people said it's 12%, and that is correct. Now, if they're long-term capital gains, you get taxed, Massachusetts taxes at the rate of 5.10%. If they're short-term, they're 12%. Within our trading software within taxable accounts, we have it flagged so that if our software ever tries to sell something that's short-term, it gets rejected, or it brings it to our attention so that we can make a decision just how bad do we want to get out of this security, because we're going to pay more than twice as much to the state of Massachusetts for liquidating that position. And sometimes, it makes sense that the longer you hold a position, the more profit you should have. So, if you're 11, 12 months into this and you can wait an extra 30 days to sell it, then you can save quite a bit in taxes. All right, so I screwed up where I was. So here we go. So in Massachusetts, like I just said, capital gains greater than 12 months, they're taxed at 5.10% in Mass. Within 12 months, the short-term capital gain is 12%. So again, I wasn't able to get anything by you guys. So kudos to you guys today. All right, so I got one more poll. IRA contributions. So let's go ahead and launch this one. When a Massachusetts resident contributes money to an IRA account, is it deductible on the Mass tax return? We got 60% of the votes coming in. Any more? Yep, we got more coming in. Okay, nice. I'm going to close it in 3, 2, 1. And the majority said the answer is no, and they are correct. So one of the things to remember when you make a contribution to an IRA at the federal level, it is tax deductible. You still have to meet certain income levels for that to be true, but we'll presume that you fall within the bracket that are allowed to deduct the IRA contributions. But no matter your income, if on your Massachusetts tax return, you are not able to deduct that. And so one of the things that you need to do is if you've made IRA contributions, you need to track your contributions that you've made since inception. And so when you start taking the money out, a portion of that distribution should not be taxable once again on the state of Mass tax return. I learned this from one of the accountants that we utilize, and I only learned this a couple of years ago. She actually sends a note out or a spreadsheet out to clients and says, show me all IRA contributions that you've made since inception, whether that's 30, 40 years. Now, don't confuse this with 401k, which is where most people accumulate the majority of their money, because 401k contribution limits are much higher than IRA. So 401ks, you are able to write off on your Massachusetts taxes. In fact, IRAs are the only ones that Massachusetts does not allow you to deduct it on your Mass tax return. You're still able to do it on the federal one, but not the Mass. All right. I just went over this one here. The final piece that I'm not going to spend a ton of time on, if anybody wants copies of the slides, they can just certainly email me or reach out to Amanda, because I have an example on the next one, on the next slide. Year-end capital gain distributions. This is something internally that we put a lot of emphasis on. Right around October, November timeframe, we start to find out from certain mutual funds or ETF providers that they're going to, whether or not they're going to pay out year-end capital gain distributions. And if you are buying into a product that has already had a nice run, you didn't participate in that run up, but now you're getting ready to invest in it and you find out that they're going to be paying a large capital gain distribution, I'll save the suspense. The math is usually not favorable. I do go through an example here, but just in the interest of time, I'm not going to go through this example because I think a lot of people want to hear about the tax reform overhaul. I'm not going to open it up to questions and answers yet. I'm going to transition and switch gears over to the Tax Cuts and Jobs Act. Once again, this was signed into law on December 22nd. Most of these rules will become effective on January 1st, 2018, and many of them will expire on December 31st, 2025. At which time we'll revert back to the 2017 rates and rules. So one of the things that they, I laugh about the idea that we're going to be able to file our taxes on a postcard, because every time they do these tax changes, I'm guaranteeing my employment for the next 5 years every time they try to simplify this stuff. So they talked about cutting down the number of brackets. The brackets are still at 7 brackets. They did not end up changing the number of brackets. They did, however, reduce a fair number of those brackets. What I'm actually going to do is I'm going to show you something. This is the Journal of Accountancy. If somebody wants to research this further and see even more than what I'm going to provide today, or see stuff in writing, if you go to journalofaccountancy.com, this is their homepage. If you look over here, they've got some highlights for what the changes are for business taxes and what it means for individuals. This one that says means for individuals has just about everything that I've come up with, or that I've seen over the last couple of weeks. They've got everything summarized right here. It's a pretty comprehensive list. So I'll just focus on married filing jointly. Here are the 7 brackets. Here are the associated income levels that push you into that new bracket. But notice that the new highest bracket is no longer 39.6. It's now 37. And we've seen a lot of changes on some of these other ones. I think the only one that didn't change maybe was the 10%. I could be wrong on that, but a lot of these went down. Notice we do have a pretty big jump from the 24 to the 32, and then these smaller increases up to from 32 to 35 and 22 to 24. So we are seeing some pretty big jumps here. I guess there's another one here from 12 to 22. But it then goes in and talks about estates and trusts, and it talks about everything that I'm bringing up here today. And it's also touching on some things that I'm not going to address. So again, when it comes to tax capital gains, they remained untouched, which is actually pretty good. So from a portfolio point of view, there's not a whole lot that needs to be done any different. There was one provision that was getting a lot of press about identifying specific shares. Some people might know it as first in, first out. What they were trying to do, what Congress was proposing, was that if somebody bought GE over the last 40 years, let's say that they just every month or every year they contributed money, usually your oldest contributions are the ones that have the greatest profit. What the government wanted to do was to force you, whenever you sell shares, to always sell your oldest shares, and predominantly that means you end up owing the largest tax. The current system allows us to specify which, they call them which lots, but in my example, which year we want to sell. So if I bought some shares for GE in 2016, I probably have a loss in those, or I do have a loss in those. I might actually want to just sell those. Well, under their proposal, they actually said that you would not be able to do that. Fortunately, that did not go through. I actually wrote our congressmen and women on this, trying to get them not to pass this, because I knew this was going to mean trouble for a lot of families there that have these legacy stock positions that wanted to sell certain years or certain lots. So fortunately that remains unchanged, so we can still specify whatever year or lot you want to sell. Sale of a primary residence. A lot of people were worried about this. There was talk about getting rid of that. When you sell your primary residence, if there's two people in that home that treat it as their primary residence, you each get a $250,000 exclusion. So a married couple that sells their home, if they have $500,000 of profit, they can sell that property and not owe any taxes. If one person is living in that home and they sell that home at a profit, they can have up to $250,000 of profit before owing taxes. They do have to have treated that as their primary residence for 2 out of the last 5 years. Again, this is the same rule that's already been in place, and that's continuing in 2018 going forward. So the biggest area of change is standard deductions versus itemized deductions. So again, these are ways that you help reduce the amount of income that you have to report or pay taxes on. So a lot of people are looking for deductions. Now, most people across the United States use the standard deduction. If you start to look in some of the blue states or states that have high income taxes, state income taxes, like Massachusetts, New York, New Jersey, Virginia, California, they have high state income taxes. And so one of the benefits for those individuals that are paying state income taxes is that we get to write those taxes off on our federal tax return as an itemized deduction. Well, that has been changed. So a lot of families in those states that had high state income taxes, they found that a lot of those residents itemize their taxes, which is the only way that you can identify certain line items that you get to group together. And if they total more than the standard deduction, then you get to use the itemized. You get to use the higher of the two, which is good. Most families already fall into the standard deduction. The standard deduction is doubling. So I think now it's going to be $12,000 for an individual or $24,000 for a family or for a couple. This means even more families are now going to use the standard deduction. Normally, I'd say just look at your 2016 tax return and look at Schedule A and see what you totaled for itemized deductions. And that might tell you whether you're above or below $24,000 to give you a sense of whether you're going to use the standard deduction in 2017 or the itemized deductions. The problem is, when you start going through the line items of the itemized deductions, a lot of those have been stripped or severely reduced. So one of the other areas, there's no more personal exemptions. That again has all been folded in to the standard deductions. So I've seen some of the stats that show that I think it was like 80 or 90% of people are now going to use the standard deduction. And so all of these talk about medical deductions, medical expenses that are hopefully deductible, charitable contributions, which are a deductible line item on the itemized tax return or the itemized Schedule A. Those things are, if you're just going to end up using the standard deduction, then you're not really going to get an immediate tax benefit. It's going to almost be irrelevant whether you made the charitable contribution or not. If you're just going to get the standard deduction, then what you do with charities is going to be irrelevant. If you happen to do a substantial amount of charitable donations or you have really high medical expenses, then in that year, it is probably likely that you'll be in the minority there of people that do file the itemized deductions instead of the standard deduction. But again, most of us are headed towards the standard deduction, not in 2017, but in 2018. Actually, in my example before, I said that wrong, where we look back at 2016. All of this is going to become effective in 2018, which again, we're not going to do those taxes until April of 2019. Let's focus on itemized deductions. Itemized deductions currently get phased out if you earn too much. Beginning in 2018, these phase outs are no longer going to exist. And while this does sound like a nice benefit, just remember that more and more people aren't going to be using itemized deductions anyways, so it's not going to actually benefit that many people. Medical expenses. This is something that people thought was on the docket of something that they were going to pull and no longer allow for medical expenses. And to my surprise, they actually kept it, and they reduced for 2017 the limit where if you have medical expenses and you want to be able to deduct them, they need to exceed 7.5% of your adjusted gross income to actually qualify as something that you can write off on your taxes. It was already scheduled that it was going to be 10% for 2017. And here, instead of getting rid of it entirely, they actually went back to 17 and said, oh, and by the way, we're going to reduce the normal schedule at 10% down to 7.5. So they're keeping it at 7.5 of AGI for the next 2 years, 17 and 2018. After 2018, medical expenses need to exceed 10% of your adjusted gross income before you can actually get any tax deduction or benefit from those medical expenses. So again, they're keeping medical expenses, which I think for a lot of the families that we help, that's a good thing. Deductible interest. A lot of people have mortgages out there. So the good news is that they kept mortgage deductions. So this is probably going to be the category of people that, besides people that have high medical expenses or make really large charitable donations, those people that have high mortgages, especially as time goes on, as interest rates go up and we end up paying more to borrow money, will end up paying more in interest charges, and that too is a deductible line item on as an itemized deduction. So the old rule is you could have a mortgage up to $1 million. So I want to go buy $1 million house, I get $1 million mortgage, and I can write off the interest on that full whatever I pay. So it's $1 million at 4%. I'm probably paying $40,000 a year in interest. I get to write off that $40,000 on my tax return. For people that are buying homes, in fact, the deadline's already passed on December 15th, 2017. So, about a week ago, 2 weeks ago, if you bought a house prior to that, they're grandfathering you in at the $1 million. If you're buying a house after that, they're lowering the $1 million threshold to $750,000 mortgage. So again, if you're buying homes that expensive and you're going to be impacted in that, you're going to see a reduction in the amount of interest that you're able to deduct. Unfortunately, they're doing away with all deductibility of home equity and home equity loans. So I know we got a lot of clients out there that have home equity line of credits, home equity loans. There's no grandfathering, I'm sorry to say. They are doing away, starting in 2018, with your ability to deduct this as an itemized deduction. Again, you're getting the standard deduction. Most people are going to apply for the standard deduction, so it might be a moot point, but I think we always felt good about having and knowing that if we had that mortgage or home equity line of credit, home equity loan, that we were also able to deduct that. Again, I stress there's no grandfathering of the home equity line of credits and home equity loans. So something called SALT, which is state and local taxes. Again, if we focus on Massachusetts, if you have wages or a taxable pension and you pay state of Mass taxes, whatever you pay to state of Mass, you get to write off as an itemized deduction on your federal tax return. This is one of the reasons why accountants will suggest that if you think you are going to owe, when you file your taxes to the state of Mass, additional, if you're going to have to write a check to them, you should really be writing that check now so that you can get that tax write-off. This is a very important year to do that. Unfortunately, they didn't give us much of a heads up on this because this all went into law last week. So if you think you are going to owe state taxes when you file your tax return, then it would be wise to prepay that and get that tax payment made before the end of this year. You can actually do it right online. If you have any questions, just give me a ring. So what they're doing now is they're lumping together all state and local taxes, which are income taxes and property taxes. So now if somebody makes $100,000 a year and they pay $5,000 to the state of Massachusetts, and they have a house that has property taxes of $10,000, that totals the $5,000 of state income tax, the $10,000 of property taxes. You got $15,000 that you can write off. What they're doing now is they're capping it. Again, this is starting in 2018, not 17. So we're not going to feel this or see this until we file our 2018 tax return. They're lumping those together and they're capping them at $10,000. So in that scenario that I just gave you, that person that has $15,000 of what in 2017 we're going to be writing off, in 2018 it's going to be capped at $10,000. This can be substantial for high income earners in Massachusetts because they pay a lot of taxes to the state of Massachusetts, and they were writing that off. And chances are, if they were earning a lot, they probably had a big house and had high property taxes. This is an area where we're going to see a drastic change, and a lot of those people that were itemizing taxes are going to find that they no longer can include those as much on the itemized tax return, and that they might actually find that they're going to be paying or using the standard deduction as a result because they stripped away a lot of these benefits. I do want to show you one of the things here, and again, it's on Yahoo. I'm just on yahoofinance.com. Homeowners race to beat the property tax capped. This was an article that was also written in the Boston Globe the other day, where they actually said that wealthy families are going in and prepaying their 2018 taxes this week or last week after it became law, or once people felt that this was going forward. And the advantage there, because most people are no longer going to be able to write off their property taxes as an itemized deduction, because most people are going to use the standard deduction. So what your mortgage is what your property taxes are for most people going forward is going to be irrelevant. It's not going to be something that you report on your taxes any longer. So what is currently allowed, it may not always be allowed, but for 2017, I actually just did this yesterday. I went to my local town, the tax treasurer, and prepaid my 2018 taxes. And so I got a receipt that showed that I paid it in 2017. And I've read a handful of articles that say that that this should work, that we should be able to deduct the property taxes that I just paid for 2018 on my 2017 taxes, because again, I'm not going to get to write that off most likely next year because I'm probably going to end up using the standard deduction. So accelerating that payment to 2017 appears to make sense. Now there's a couple of caveats. They've said that because of how it's structured, you're probably only going to get to write off half or 2 payments of your 2018 property taxes, because the last 2 haven't been determined. They haven't been calculated yet by your town. I paid the full amount. When you read these articles, there's talk of senators actually proposing that they allow you to write off the full amount for 2018. For people that that don't have high property taxes, I don't think this is going to be something that you need to run out and just do today. I don't think there's going to be a huge benefit. But if you have substantial property taxes and you have high state income taxes, those things are going to be severely limited next year. And for a lot of people, we're just going to see that that we're going to end up filing the standard deduction instead of the itemized deductions. So again, in theory, or what I would tell most people is check with your accountant. The reality is that we only have a couple days left in this calendar year, and the accountants may not even get back to you before that. So if it'll be something that you'll have to actually look at. If you want to run through some numbers, feel free to give me a call, and I can help you with that. But it is something that, especially wealthier families, there's going to be a bigger bang for your buck and a bigger benefit. And you can certainly read this article on why they're seeing that a lot of people, especially in states that have high property taxes, are prepaying their 2018 tax bill. Charitable contributions, I already referenced. Unfortunately, most people, it's not going to matter anymore. In fact, what it is going to favor is what I talked about before, making charitable contributions directly to the charity from your IRA, and you can only do that up to 100,000, and you must be over 70.5 to do that. That is still going, that's going to become even more powerful, because most charitable contributions are not going to be large enough that it's going to justify using the itemized deductions, which is where you report charitable contributions. Miscellaneous itemized deductions, that's something that they're doing entirely away with. So on your tax return, on the itemized deductions down at the bottom, it would say, report what you paid your accountant, report what you pay at a firm like mine for your taxable accounts. So these are and will be deductible in 2017, but starting in 2018, they are no longer going to be deductible. They've taken that entire section out of it. It's the area that was called miscellaneous itemized deductions, subject to the 2% of AGI. Next category, I actually had hopes that they were going to do it away with alternative minimum tax, but unfortunately, that was not eliminated, but fortunately, the exemptions and phase-outs were increased. So we're going to find that fewer and fewer people are going to be impacted by the alternative minimum tax, or AMT. Again, this is impacted starting in 2018. As I mentioned earlier, one of the ways to increase your tax credits is to have more children. They're doubling the credit from 1,000 to 2,000. They have to be a dependent, and these are pertaining to your children. They have to be a dependent, and they need to be under the age of 17. They added a new tax credit called dependent credits. So these are for people that are not your child, not qualifying for the child tax credit. For example, if you were taking care of mom and dad and you were their caregiver and they were living with you. That's just an example. You need to determine whether they're dependent of yours, but now they're giving you a $500 credit. And again, credit is good because it's a dollar for dollar reduction in your tax liability. 529 plans used to just be for college. Now we can use up to $10,000 a year towards K through grade 12 expenses. That's $10,000 per year per child, and it starts in 2018. Student loan debt. If somebody passed away and they had outstanding debt, sometimes that debt is discharged. It's written off. But if it was written off, you would get a 1099 from the student loan showing that you have to report this as income because it was written off, and the IRS would charge income taxes on the amount of student loan that was written off. They did away with that, and if somebody dies or the student loan is discharged due to death or disability, this is something that's no longer going to be required to be reported as taxable income. And a big area that we deal with is estate taxes. Estate tax is still super important in Massachusetts because if you pass away with greater than $1 million and you leave it to a non-spouse beneficiary, then death taxes or estate taxes are going to be owed. When you're dealing at the federal level, the number has steadily increased, and believe it or not, starting in 2018, somebody can pass away with $11.2 million and not owe death taxes at the federal level. They will still owe, if they live in Mass, they will still owe death taxes on to Massachusetts for anything that exceeds 1 million. But now at the federal level, it's up to 11.2 million, or for a couple, now they could save and pass on to their family or someone else up to $22.4 million estate tax free, death tax free. The other nice perk, and I've always been concerned that they were going to do away with this, is what they call a step up in cost basis. So when somebody passes away and they have a taxable account, if I purchased Amazon for $5 and when I pass away it's worth $150, my kids, if they're the ones that are inheriting this asset, my kids are not going to owe taxes when they sell Amazon. Their new cost for that stock is $150, whatever the value of that stock is when I passed away. That's a huge benefit for children who are inheriting taxable assets, especially legacy positions. And that's one of the reasons why when somebody gets older of age, we are very reluctant to sell positions that have huge embedded profits. I got 4 more areas. The kiddie tax, how am I doing on time here? I've pretty much exceeded it. So I'm going to fly through these and I'll just open it up to questions. Kiddie tax, children who have unearned income, they used to pay taxes on that unearned income at their parents' rate. And going forward, they're going to be taxed as trusts at the trust tax rate. That is not good, by the way. Let's see here. People that divorce or separate after December 31st, 2018, if you pay alimony, it used to be something that you would deduct, and the person that received the alimony would report it as taxable income. After December 31st of 2018, so it seems like they're giving us time here, the alimony will not be a tax deductible to the payer, and the payee will not have to pay income taxes on that going forward. I said I would talk about businesses, 2 line items. Corporate tax rate, this is the biggest perk that has taken place with this tax reform. This is what many people are hanging their hat on, is that the corporate tax rate went from a graduated 30 up to 35%, and now it's just a flat tax at 21%. We'll see how effective it is. It does appear that it is going to add value and improve corporate balance sheets because they're going to pay less in taxes. I did just read, and I've read a couple of times, that the average or effective rate that corporations are paying already is around 21 to 22%. So we'll see just how much in actual savings we see. But we're already hearing from corporations that are paying bonuses to employees as a result of this, that are going to expand and hire more people. You'll see stock buybacks for sure, and you'll see increase in dividends that are paid out from publicly traded stocks. Those are almost certainties, and that should help and has helped the stock market climb. And finally, pass-through businesses. Business owners may qualify for an additional 20% exemption or deduction on business net income. So again, business owners, they have to work with their accountants to just determine what their proper business structure should be, and how these changes are going to impact them, because much like personal income taxes, business tax returns are specific to that person's situation and needs to be reviewed with a qualified accountant. One, fair disclosure, I am talking about a lot of taxes here. You really need to talk to a qualified accountant if you're going to make big decisions here that are going to impact your finances or tax scenario. They are the specialists in this area, so it makes sense to consult with an expert. What I'm doing is trying to take that information that I've seen out there and help cull that list down to some actionable things that I want people to pay attention to, and build action steps after once you do your research to determine whether some of these things are going to help you or hurt you, and see if there's other ways to improve on that. What I'd like to do now is open it up back to Amanda and see if there are any questions that came through.
Hi, Jamie. Thank you so much. Just a reminder to use the questions section here on your taskbar if you do have a question, and we'll try and get to all of them here now. But if not, one of us will reach out to you to answer your question and make sure we get that answered for you. So the first one I have here is, how are these changes going to affect paychecks we receive from our employer?
Yeah, so we actually read that places, the big players like ADP and Paychex, they were pleading for some kind of window that they would have so that it's not January 1st that this stuff applies, because they have to change a lot of their systems to accommodate these new tax brackets. It's really the tax brackets that are going to influence how much they have to withhold. So they'll have to go through some different calculations, and it should result in a lot of people paying less in taxes or having less taxes withheld. Obviously, there's more than just your payroll and salary that goes into determining your tax liability. But yeah, we should see some changes, and that's something that they're actually working on as we speak.
The next question I have is, I am at the age where I now have to take an RMD. Can I put this money into a Roth?
Yeah, so you can't put the actual RMD into the Roth, but you can do an additional on top of the required distribution that you have to take out. You can take more and move it over to a Roth. So for example, if you have an RMD, required minimum distribution of $30,000, you have to take that out of your IRA account. If you then want to move an additional $20,000 from your IRA over to a Roth, you are allowed to do that. There's no age limit on that.
Do the tax reform changes impact retirement savings plans?
No, in fact, they didn't touch any of that. That's all governed mostly by ERISA, and I don't recall the last change that we've seen in ERISA, but they left almost all of that untouched.
Looks like I just have one more. I'll give everyone a little bit longer to submit your questions, but the last one I have here is, should everyone who owns a home prepay their 2018 property taxes in 2017?
Yeah, I mean, that's a tough one. The lower your property taxes, the less significant this is going to be. And it all depends on whether they're going to really allow us to write off the full 4 payments of property taxes in 18 or just the first 2. If your property taxes are $5,000 and they're going to only allow us to write off the first 2, that's $2,500 that in theory you should be able to put onto your tax return. But, you have to be itemizing in 2017, and I got a lot of people that don't already itemize. They use the standard deduction. So, I think for many people it's not going to be worth it. I think for many of our clients who tend to be on the wealthier side, it's a self-selecting group that they tend to be wealthier and have higher property taxes and are more likely to itemize. Then yeah, I know if you're sure you're going to itemize, then I don't see a lot of downside to this.
Jamie, I think that's it for questions.
Excellent. Well, thank you once again, everybody, for joining us. I know I went a little bit over. I apologize about that. I want to wish everybody a happy and healthy new year. And if you have any questions, please feel free to reach out to us. Take good care.